Okay, quick question for you. Can you use your CGST input credit to pay off an SGST liability? Now, if you paused for even a second, you need to listen up because this is a classic ICAI exam trap, and so many students fall for it. Stick with me, and I promise you won't just memorize the answer, you'll get the core logic of GST so you can handle any question they throw at you. Let's dive in. So to really truly understand why GST is such a big deal, we have to travel back in time and look at the absolute mess it cleaned up. And believe me, it was a costly mess for everybody. The old tax system had this hidden trap that just made everything more expensive. Let me show you exactly how it worked. All right, look closely at this table, because this is where the whole problem started. You've got a manufacturer with a product valued at 1,000 rupees. Simple enough. The government comes in and adds an excise duty of 12.5%, which is 125 rupees. Okay, still with me? But here's the kicker, the trap. When it's time to calculate the state VAT, it's not based on the original 1,000 rupees. Nope, it's calculated on 1,125, which is the value plus the first tax. Now, this problem has a name, and you've got to know this for your exams. It's called the cascading effect of taxes. It's literally, and I mean literally, a tax on a tax. In that example, you weren't just paying VAT on the product, you were also paying VAT on the excise duty. And this just created a snowball of taxes rolling down the supply chain, making everything way more expensive for the final customer. So, the big question is, why should anyone have to pay a tax on a tax, right? It just doesn't feel fair, and it's definitely not efficient. And that single fundamental problem is what led to the biggest indirect tax reform in India's history. So what is GST really? Well, the official definition is a destination-based value-added tax. But look, let's forget the jargon for a moment. I want you to focus on just two words, value-added. That's it. Those two words are the key that unlocks this entire system. You see, the engine that makes GST work is this beautiful, seamless chain of tax credits. We call it input tax credit, or ITC. The idea is actually brilliant in its simplicity. At every single step of the supply chain, a business gets a credit for the GST it already paid on its purchases. This one move completely breaks that painful old cycle of tax on tax. Let's see how it actually works in practice. So let's picture a really simple supply chain, okay? A manufacturer sells to a distributor. The distributor sells to a retailer. And finally, the retailer sells it to you, the consumer. Now, let's put some numbers on this to see the magic happen. Okay, lean in for this one, because this table right here is the big aha moment. The manufacturer adds value, sells the goods, and pays 18,000 rupees in GST. Now, when the distributor buys those goods, that 18,000 rupees becomes their input tax credit. So when the distributor sells, their total tax bill is 20,016. But, and this is the game changer, they don't pay that whole amount. They get to subtract their 18,000 credit and only pay the difference, which is 2016. The exact same thing happens again with the retailer. Do you see it? At every stage, the tax is only being paid on the value they added. So, what's the end result? It's simple. The tax is only on the value added at each stage. That cascading effect, poof, it's gone. Now, the final consumer still bears the total tax burden. If you add up that last column, that's what the consumer pays. But the system is finally transparent, efficient, and fair. There's no more tax on tax. All right, so we've nailed the why of GST. Now let's get into the how. Specifically, how this all works in India's federal system. And you really need to pay attention here, because this is crucial for all the practical problems you'll face in your exam. In India, GST is split depending on where the sale happens. It's pretty straightforward. If a sale happens within the same state, say from Mumbai to Pune, we call that an intrastate supply. Two taxes get charged, CGST for the central government and SGST for the state government. But if that sale crosses a state line, say from Delhi to Mumbai, that's an intrastate supply. And here only one tax is charged, IGST.
So these are the four pillars, the four names you are going to see in every single exam problem. You've got CGST for the center, SGST for the states, UTGST for the union territories, and the big one, IGST, that handles all the transactions between states.
We need to figure out, why do we even have both CGST and SGST in the first place?
Well, it all goes back to the Indian Constitution itself, specifically Article 246A. Now, this is the really important part. This article gives power to both the central government and the state governments to charge GST at the exact same time on the very same transaction. It's a principle called fiscal federalism, and it's literally the foundation of how GST works in India.
So let's circle back to that very first question I asked you. This is a classic MCQ trap. A supplier has 100 rupees of CGST credit and 100 rupees of SGST credit. They have to pay an SGST liability of 50. Can they use their CGST credit to pay it off? What's your gut instinct? A lot of people might say, yeah, sure, why not? And that is the huge common mistake. Students think, well, CGST and SGST, it's all just GST, right? Two pockets on the same pair of jeans. They assume you can just move credit from one to the other. And I'm telling you, this is exactly where marks are lost, in both MCQs and practical questions.
That's enough theory. Let's see how this all plays out in a real, practical, exam-style problem. All right, so let's follow a product down the supply chain. Supplier A sells some goods to B for 10,000 rupees, and it's all happening within the same state. So, A charges 900 rupees of CGST and another 900 of SGST. B pays the total, 11,800. Now, that 1,800 rupees in tax that B just paid, that becomes B's input tax credit, or ITC. And specifically, B now has an ITC of 900 for CGST and 900 for SGST.
So what's next? B adds a 20% value to it and sells the goods onto C for 12,000 rupees. Now on this sale, B's output tax liability is 1,080 rupees of CGST and another 1,080 of SGST. So B owes a total of 2,160. But remember, B is also holding that input credit of 1,800.
And here it is, the million-dollar question, the one you'll get in your exam. How does B use that ITC to figure out the final tax they actually have to pay in cash? Think back to that first slide we saw. Can you spot the trap here? All right, let's get to it. This is the most crucial part of this entire explainer. This is exactly where marks are either made or lost in the exam.
And listen, pay very close attention right now because this is a favorite area for ICAI. They love to twist this in MCQs and descriptive questions. They really want to check if you understand this fundamental rule.
And here's where it all becomes crystal clear. The wrong way is to just pull everything together. Total output tax minus total input tax. No. The right way is to treat them as two completely separate accounts. Your CGST liability can only be paid with CGST credit, and your SGST liability can only be paid with SGST credit. They are parallel lines, and they never, ever cross. So here's how you do it the right way. We handle CGST first, on its own track. The output tax is 1,080. We use our 900 rupees of CGST credit. That leaves a net payable amount of 180. Then, completely separately, we do the same thing for SGST. Output of 1,080 minus the SGST credit of 900, which leaves another 180. The total tax is 360, sure, but it's specifically 180 to the central government and 180 to the state government.
So GST's real genius was swapping out a broken, messy, tax-on-tax system for a clean, simple, value-added system. And it's all built on that seamless flow of input tax credits.
For intrastate supplies, always treat CGST and SGST as two separate taxes with two separate credits. They live in two different houses and they never, ever mix.